So this week we're talking about investment fundamentals and different investment securities and vehicles. So before we start investing, we have some initial concepts that we need to go over. So we want to make sure that before we even consider investing, we have all our bills paid, all our credit card debt covered, that we're making monthly, payments to basically, so that we don't pay any interest on the credit cards. We want to make sure that we have a balanced budget, that we don't have a deficit in our budget, so we are not borrowing, because investment is something that you want to do with your budget surplus, not on a borrowed or a deficit budget. You also want to make sure that we have some emergency cash stashed away, just to make sure that if there are any emergencies, that we are ready financially to cover for them. We also want to make sure that all our insurances are paid on time and they're all valid and ongoing. While retirement contributions are investments, what we refer to here is on top of your savings for retirement. So we also want to make sure that your long-term retirement savings are done before we start considering an actual investment strategy. We also need to prioritize our investment goals. Why would you like to invest, and what is your priority? So your book starts by talking about how people invest so that they would have extra money for a vacation. Everybody has different goals, obviously, and your priorities may be different than mine, and therefore it really is not possible to prioritize why or generalize these priorities. Something that's very important to you may not be important to another person. So these are just some of the common priorities why people invest, or why people would like to make investments. We want to make earn some money to have a vacation, and perhaps a nicer one than we usually have. We like to buy a new vehicle, a newer, nicer car. We want to generate an additional income. So like, for instance, in previous weeks, I have shown to you that I started a little bit of an account for my daughter, who's only 8, and whenever we have some additional money, we just set it aside for her and invest in securities that generate a monthly dividend. And so far, the income that we generate is very little, but she's also very little. So hopefully in the future that will accumulate to something more, and hopefully she will have some sort of additional income. So people invest with the goal of creating an additional income that will be on top of your actual paycheck. People invest to have, pay for education, perhaps pay for your student loans, pay for further education at graduate school, or pay for your children's education. But investment would certainly pay for such educational expenses. Perhaps people would like to start a new business, and investment income may, or the return that you make out of investment may actually enable you to start this new business. You may be able to set aside a sum that will be sufficient to start a new business. Or simply you want to have more retirement savings, and you like to actually have more money to spend when you're retired, perhaps more income. So obviously, having the goal, the priority of a vacation, a vehicle, these are more of a short term, within the next couple of years, investment goals. Having a more income, education, new business, or retirement, these are longer term investment goals. So how do we start investing? I mean, this basically, talks about how do we find the money to start investing. And a lot of the times, the idea is to set aside within your budget perhaps any surplus that you have, you allocate it for your investment um, account. It is really advisable that you open a brokerage account at a company, a reputable national brokerage company. Most companies will not require you to put significant sums of money. Even you may not even have to put anything in it. However, that account will start to become a motivation for you to set aside some money and put it in there, and perhaps start buying some stocks and bonds and ETFs and mutual funds, even without perhaps set goals, just to start that experience of investing in financial securities, creating some sort of a portfolio, trying to figure out how to buy, how to find, and perhaps come take some classes with us where we talk about investments. We also have in the College of Business, for instance, a $1 million real funds, a portfolio that we manage. And that in that class, we basically talk about how we allocate that money into an investment choices, various investment choices. So having that brokerage account is a priority. And then once you have it, it may be nice to set aside some money from your paycheck and then just put that into that brokerage account and start accumulating your investment budget. Every year, if you have a tax refund, if you have any bonuses from your job, you get your gifts from your parents, different sources, but unexpected cash that comes your way that you have no need. I mean, people always need money, yes, but if you could set aside just some percentage of it, perhaps for your investment, that would also contribute towards your brokerage account. It may be nice to save to invest. I mean, think of it like this. Any money that you actually have in your savings account obviously is for emergencies that generates very little income, staying at a savings account. But if you were to set yourself an amount, how much you want to keep in your savings account, and anything on top of that, you would perhaps put it into an investment account. And that would also, get you into a habit of saving to invest. Perhaps work extra to invest. Perhaps a second job that may not be as time consuming or as demanding. For instance, perhaps tutoring, working for the university, and that sort of thing that would generate an extra cash, and that you could put it into your investment account and start to invest. So what type of returns can we expect from investing? So we talked about how the checking account has no interest whatsoever, or even if so, it's negligible. And then savings account also is very, very low in interest rates, although it's very versatile that you could actually withdraw money up to a certain number. And then a CD locks in your money and you can't really touch it. And the interest rate is higher than a savings, but still really low. So what is a realistic investment return? Well, let's talk about different kinds of investment securities. Next chapter, we're going to talk about more, what's a bond, what's a stock, what's a ETF and a mutual fund. But think of it like this. In the economy, government is the biggest borrower. And as the biggest borrower, the US government borrows through what's referred to as treasury bills or notes or bonds, promissory notes. And we consider in finance that a short-term US treasury bills, promissory notes, to have no risk whatsoever. In fact, in the financial theory, we refer to these treasury bills of short term, 1 to 3 months. Actually, up to 13 weeks. So we refer to these as risk-free securities. Right now, they pay approximately 1.5% per annum, which means that risk-free investment right now makes you 1.5%. Now, based on that, be realistic in your expectations. If somebody promises you that you're going to make it 20% a year, well, be suspicious, be skeptical. Madoff paid 20% for 20 years, and it turned out to be a Ponzi scheme, and he's now in jail for it. And thousands of people lost their lifetime savings. Millions and millions and billions of funds have been stolen. So be realistic on how much return do you expect and how much risk you're going to take. In fact, if something is offering you 20% return, know that given the treasury bills are 1.5%, you are being exposed to excessive amount of risk. So if the risk is high, the return may be high. But if the promised return is high, know that you are being exposed to a definite high risk. There is no free cash. There is no free lunch. If somebody is promising you a significantly high return, that means your money is being risked and you are taking a high risk. The rate of return or the yield is always announced as a percentage. So 1.5% per annum is a yield or rate of return. 5%, 6%, 7% are rate of returns or yields. It is important to start your investment early because your money will have time to compound. And we talked about this in previous weeks, but think of it like this. If you invest and you're making 10% a year, which is excessive risk right now, but let's say that you're making 10% a year, the more years you have to earn that 10%, your money will compound and your money will start to make money for you. Even the compounded amount will make money for you. And therefore, the more time that you have, more time your money will compound and more money you're going to end up making, even at a small amount. If you were to start saving early, you will have more money at the end compared to somebody who starts midlife or late in their careers. You need to have an investment philosophy. Everybody's different. You may be a pure speculative person or a pure risk person or a very risk averse person. Think of it like this. We have different definitions for this. A risk lover, let me give you an example. If I were to have a dare and say, would you jump from a second floor for $10,000? How many people would accept that dare? Now, if I were to change the dare and say, how many people would jump from a third floor for the same $10,000, $50,000, or $100,000? You see, the dare becomes higher the risk, higher the pay. Meaning, if it is a second floor and you need to jump, then there is, let's say, $10,000. But if it is a third floor, then you would expect the payment to be more because you're taking more risk. Now, I would never make such a dare because I know that it exposes people to excessive amount of risk. But from a receiving end, people may actually look at this dare, and risk lovers will simply jump. They will not require payment. Those are the people who actually put those videos and go jump from very high places, and you just do it for the exhilaration of it, for the adrenaline of it. And those are the risk lovers. So from a receiving end of an investment, these are the people who will simply take pure risk. Risk lovers. They will just take it for the sake of risk, and the return is not their concern. On the other hand, people who will consider taking a reasonable amount of risk for a reasonable amount of return are referred to as risk averse people. Now, most investors are risk averse, meaning that they will consider risk and they may take risk given enough compensation is provided. And therefore, speculative risk will become more of the people who are okay to take risk, but they have a lower threshold, if you will, and they will be okay with some compensation. But with the investment risk, now you're talking about investment level of risk and gains and losses, meaning that we want to have a proper amount of compensation that corresponds to the level of risk that we're being exposed to. So a risk premium refers to how much additional return do you require to take investment risk for the additional risk that you're being exposed to. So if a US Treasury bill pays about 1.5%, and you want to invest in a stock, let's say a stock of Apple company. Well, initially, you want to earn the 1.5% that you would otherwise earn by investing in risk-free Treasury bills. So why would you invest in Apple's stock and expose yourself to the risk of Apple company? So that is the risk premium, that you need to be paid an additional compensation so that you would accept taking that additional risk for that additional compensation. So higher the risk, it must be that higher the risk premium. However, that doesn't necessarily mean higher return. So just because there's high risk, it's not necessarily mean that you will earn the higher return. You might actually lose. The risk refers to your likelihood of losing or making money, and losses and earnings come hand in hand. However, the opposite is correct. So if you have a higher return, you have taken a higher risk. Just keep that in mind. There are two types of investors, active investors and passive investors. Active investors are the people who try to time the market, frequently buy and sell. Although timing the market really does not work, simply because the markets are too efficient, and therefore timing the market is just a futile attempt. Passive investors are long-term investors. They just accumulate, and they don't do buying and selling frequently. Being an active investor is time-consuming. As a student, it's distracting. If you are working at a job that demands your full-time attention, being an active investor will be attention. It will actually take your attention from what you need to do. There are two ways to invest. You could lend or you could own. When you lend, you're investing in securities called promissory notes or bonds. When you own into a stock or some sort of an equity. There are different risk factors that you will be exposed to when you invest. Random risk or unsystematic risk is referred to the risk that associated with the specific security that you're investing. So for instance, if you invest in a stock of Apple company, then you are being exposed to the risk that's specific to the Apple company. And this is that unsystematic risk that defines it. A market risk or the systematic risk is system-wide. That is the risk that you're exposed to by simply investing in any security that exists in a market. Any security that exists in a market. So for instance, we live in the US, we operate and we invest in the US, and if the Federal Reserve changes the interest rates, that affects every security out there, and therefore this type of risk we are exposed to. Now, if you're talking about unsystematic risk, you can diversify, meaning you could buy Apple, and then you could buy Samsung, some competitor, maybe you could buy Exxon, or just different companies, just as an example, just different companies, and that would actually get you to diversify the unsystematic risk or the random risk that you're taking. However, the market risk is harder to diversify because you operate in a market, so you need to diversify through different markets. But then every market is integrated, so there is something called contagion. One market goes down, all others will go down with it. Therefore, market risk is very hard to diversify, and many consider it as undiversifiable risk. So the systematic risk is undiversifiable, but unsystematic risk can be diversified away. There are different types of risks that you're being exposed to. Business failure, inflation risk, regulatory risk, market volatility, global investment risk, and liquidity risk. These are some of the examples of risk that you're being exposed to. Notice the market volatility refers to the systematic risk. Global investment risk is just the same. If you invest in any other country than the US, you're still being exposed to the market risk or systematic risk. And the liquidity risk is specific to the security that you're investing in, which you may not be able to sell, or you may not be able to sell without cost. When we invest, we are exposed to some sort of commissions and some sort of fees. Take a note of these. These can accumulate. So for instance, like we talked about how when you have a paycheck, perhaps you should invest some, but notice that every time you buy a stock, you pay somewhere around $10 to $15 per transaction. And then there are some companies that charges even more. Commissions, there are some fees that are involved in investing in mutual funds, just to make sure that you know what type of commissions and fees you're going to end up paying, because they can add up. And leverage or borrowing to invest is really dangerous. It exposes you an additional risk. So think of it like this. Brokerage companies, very much like credit card companies, they will be willing to lend you money to invest. So let's say that you borrowed, I don't know, say $10,000 to invest. You borrowed $10,000 to invest. And then you lost. Say you lost 20%, $2,000. Well, now that $2,000 you lost on borrowed funds. Now you have to pay it back. And you lost the money that you do not have, and therefore you basically gambled with it. So it doesn't become an investing. In my opinion, it becomes more of a gambling. And gambling habit is an addiction. So you may want to be very, very careful about borrowing to invest or having significant leverage to invest. There are some investment mistakes that it would be advisable to avoid. Know that financial markets will fluctuate. They will go up, they will go down, they will go up, they will go down, they will fluctuate. So timing the market, you could actually time it so that you buy at the worst time and sell at the worst time, and then you just lose all around. We always think about the best case scenario where we buy at the best time and we sell at the best time and we make the best profit. But what if you actually bought at the worst time and sold it at the worst time and you lost? So know that financial markets will fluctuate. Know that investing is a long-term, and it takes patience and it takes a lot of learning. It pays well, so you need to learn. However, you have to be realistic. There are always tax consequences, death and taxes, certain. There are always tax consequences. So you need to make sure that you know what type of tax situation that you're in, and make sure that you factor that into your investment decision. Taking too much risk. If you want to have high return, you think that you have to take high risk. But risk also means that you could lose just as much. And therefore, again, everybody's different. The younger you are, probably you will be more about taking more risk because you have more time. Older you are, then you're probably taking, or you're being more conservative just because you don't have that much time and to accumulate, and therefore you don't want to lose or risk losing substantial amount of money. However, Having said that, taking too much risk does not mean that you are certain to make too much return. It also could mean that you could lose substantial amount of money. So you may want to be careful about how much risk you're going to be taking, and how much money that you are exposing to such risk. Borrowing to invest, like I said about the leverage, it really is high risk, and it exposes you to risk with money that you do not own. And when you lose, you still have to pay it. Not investing at all. Well, whatever we actually talked about might actually scare you from investing, but it shouldn't. Because as long as you know what you're doing, meaning, you buy a few stocks here and there, you buy a few bonds here and there, you buy a mutual fund or an ETF, and you start small and you start accumulating small and you start learning about this. You read about it in your free time, and you're going to realize that you are making some return, and maybe not much, but still you will learn. But if you do not invest at all, then you're missing out on an opportunity of having an additional return, having an additional income, reaching your financial goals. And therefore, that is one of the investment mistakes that people do, that they simply avoid investing at all costs simply because they don't want to lose their money. I understand that, been there, done that. But the issue is that you want to invest with the amount that you feel comfortable, and you want to basically start learning little by little, and not rush and not take too much excessive risk. And once you learn it, you will realize that you will feel a little more comfortable, you will have more questions, and then you will learn more, and then you will invest more, and so on and so forth. Another mistake that people do, they try to time the market. Everybody has some opinion about the market, some right, some wrong, but timing the market, we consider the markets to be efficient, and therefore time the market should not work. In any case, this is our fundamentals of investing, and we'll talk about different investment tools in our second chapter of this week. So if you have any questions, please let me know. Thank you.